Well, folks, it's a four-piece in this one here today. Four videos up for me to react to. We got drama going on in the stock market. It's getting to be a lot of fun out there. First one I want to react to. Expect a lot more market volatility until the end of October. I want to share my opinions and perspectives. If I see a lot more volatility coming in this market, a lot more downward moves. We're at a pivot point in the economy, says Rockefeller's capital management, Greg Fleming. Looking forward to reacting to that one, sharing my opinions and perspectives there. August jobs report doesn't scream a recession, says Tim Seymour. That should be an interesting one to react to. And then maybe my favorite one I'm looking forward to reacting to in this video. If you crush the wealthy for certain things, you crush everyone else for the same thing. I think that's going to be an interesting one to react to in this video here today. Japanese stock market, still a little bit of a drama show over there. And then Nikkei, again, down 2+%. So we'll see what happens in the Japanese stock market. Got a brand new workshop for you guys. I just created this a few days ago. It goes into essentially how to position your portfolio, what type of stocks you want to buy for next year. I'm already thinking, we're very shortly here. We're going to be in the fourth quarter of 2024, right? So I'm already thinking about how do you want to position your portfolio for 2025? What are the type of stocks you want to own? So free workshop for you guys. Pin comment down there to access that and send it over via email or via text, whatever you prefer there. That'll be pinned comment down there today. All right, guys, let's get into this.
Strategist. And Sam, this jobs report has gotten ever more important over the last many weeks. We're waiting on seeing what happens there, and we know the Fed's waiting too. So how are you feeling as we get back into this whole season of September? Everybody's back to work. Traders are back too. It's been a little choppy so far.
Oh, sure, it has been, Becky. I think investors have surrendered to seasonality in the first two trading days of the month, and I think there's going to be a lot more volatility until the end of October, which historically has been the case. All sizes, styles, and sectors within the S&P have posted average declines going back to 1992. But I think in terms...
Yeah, if you're wondering when does a stock market usually bottom in an election year where the sitting president is not running, essentially what we're looking at here is usually what happens. That doesn't mean this is a guaranteed to happen, but usually how it works out is the market will bottom late October and then again kind of do a double bottom in late November, okay? And then head up for real in December, and then, obviously the next year is the next year. But if you're wondering how this usually plays out, usually downtrend kind of into this. Now, there's a nice bounce back usually that comes, actually it should come within the next 1 to 2 weeks. Should be, once again, no guarantees, but this is what usually plays out in the market. You should get a nice big bounce back over the next either week or two in regards to the market, and then there's another downward trend that ends up leading all the way until about late October.
Employment data, we probably will end up being favorably surprised with today's ADP report, with the jobless claims, and also with the payroll numbers on Friday. I think we'll find that a lot of the weakness in July was weather related.
So if we're going to be favorably surprised by these things, the next question for investors is, how does the Fed react to that? You think that would set them up for a 25 basis point cut?
I think that it will be setting them up for a 25 basis point cut. That's our expectation for a total of 3 cuts of 25 basis points each for this year, and then 4 more cuts next year. Our feeling is that, if you look back to Fed rate history, that only twice has the Fed cut initially by 50 basis points, and that was in 2001 and 2007. So I think investors will probably end up feeling that the Fed knows something we don't if they cut by 50 basis points this time as well.
So I'll say this. It's very silly to try to assume what the Fed's going to do next year. I'm just going to be honest. The Fed has no clue what they're doing 6 months from now. They have no clue what they're doing 12 months from now. And a lot can change in 6 months. A lot can change in 12 months. So if you want to predict down what the Fed's going to do here into the year end, fair play. But if you want to predict what they're going to do next year, honestly, it's all bets off. All bets off in regards to that.
That's what we've heard back and forth. But we also heard people that we spoke with yesterday who said, look, if they don't cut by 50 basis points, we're going to be in very big trouble because the economy is worse than expected. 2022
is a perfect example of that, right? 2022, the Fed never saw themselves basically raising interest rates as fast as they did. That was never in the dot plot for the Fed. Additionally, Wall Streeters were I didn't see one person on Wall Street predicting what was going to play out there in regards to Fed funds rate and how high that was going to go. And we saw that play out, right? So, to try to say, oh, we think they're going to be, 3% at this time next year, 3.5, like you can do that, but you're throwing darts at a dartboard. I'm just being honest. There's a possibility, there's a potential here, a real potential that Fed funds rate could be 1% or 0% at this time next year, right? Let's hope that doesn't happen, because if that happens, that means the economy completely fell apart. Corporate earnings started to just tank in 2025. Let's hope that doesn't happen, but there's a potential there, right? And so to try to draw these conclusions about, oh yeah, we think it's like for next year, no, don't do that.
You don't believe what we saw in July, some of those early readings that we got in July and last month. You think that this is really a much stronger economy than some of those negative naysayers are thinking?
Yes, we do. We actually raised our GDP forecast for this year and next. Was 2.7 for this year, now 2.8. Was 2.1 for 2025, now 2.2. Our feeling is that while the economy will be slowing next year relative to this year, that we will still be on course for a soft landing. Plus, I think the market really has not been moving in the direction that investors really would like. And so once again, investors are acting like hyperactive first graders playing musical chairs, always trying to out-anticipate the other.
Okay, you've said from a technical perspective that when you get to this overbought conditions, you're looking at the market as being overbought. That's what's causing these sell-offs. So you think the economy's strong, but maybe you think the markets are highly priced, I should say?
Well, I think that there is some benefit to digesting some of the recent gains. We're still looking at technology trading at a 50% premium to its average 20-year PE on forward estimates, but that's certainly down from a 78% premium that we saw just recently. The S&P 500 at a 30% premium, down from 38. So I think that we are getting there, and plus, when you do have an overbought situation, doesn't mean the world's coming to an end. It simply means that the dials are going to be reset. So we're still firmly in the bull market camp, but just feel that the market has gone a bit ahead of itself.
That's okay. If I'm sitting at home and I'm listening to this, I think, okay, so that explains the huge, vomit that came out of the market on Tuesday when you were looking at any of the semiconductors or anything across the board, that it doesn't have anything to do with the potential for a subpoena that did or did not come to NVIDIA. NVIDIA is saying they didn't get a subpoena. This is just investor sentiment turning on a dime because we realize, oh my gosh, we've really bid things up.
Well, certainly when we look at the semiconductor group, and this is a group that was up by 3 digits, 100+% over the past 12 months, et cetera, trading at a PE multiple that's about 80 times or an 80% premium to its long-term average. Yes, you can look to individual groups of the overall marketplace and see where there has been excess. But at the same time, while the semiconductors have been readjusting, we have been seeing a broadening out of the overall marketplace. So seeing those groups within the 1,500 that are above their 50-day, above their 200-day, and above both of those indicators, we're seeing actually an increase along the way. So I would regard that more as a positive spreading of expectations rather than being shaken by simply one group going through a digestion.
Sam, do you think we're in for a big drop in the markets in September or October or not?
Well, there's certainly a possibility. Since World War II, we have had 30 times that we have had 2 intra-year declines of 5% or more. And in 9 of those 30 times, we had 3 or more. So if we do end up falling into a decline in excess of 5%, history says it'll probably be in the low double-digit area, 12.5% being the average. And certainly that could shake investors' mindset. But typically you get back to break even in an average of only 4 months from declines of up to 20%.
So 2 things I didn't like about that interview there. One is, he mentions, he thinks the economy is, really strong. The economy is so vast, so massive. What about it is strong? Everything strong in it? Like what specific angles are you going at? What, specific points are you pointing at to there, right? I think that's really important. The second thing I didn't really like about that interview, just to be quite frank, was he was mentioning about, the stock market kind of being overvalued or tech stocks, but once again, you can't just put all tech stocks in the same exact kind of frame of thought, right? You have, let's say, an Apple trading at a forward P of 32, 33, right? With very minuscule growth rates recently. You have a Meta, on the other hand, trading at a forward P of probably 24 and has incredible growth rates, right? And so you look in there and it's like, well, there's a big difference between this company and this company, right? You look at NVIDIA versus AMD. Well, sure, they're two semiconductor companies and they can get grouped together, but the business results from those two companies are very differently. And so I hate this kind of like grouping of everything together. So that's just kind of something that kind of came to my mind as I was watching that there. And this is why you as an investor, like what can you take from something like this, right? You've got to think on a higher level more than just grouping everything together and kind of stereotyping it all and saying, this is all overvalued, this is all undervalued. Like, it doesn't really work like that, right? Additionally, they spoke about, are you expecting a big market drop? What's a big market drop, right? To some people, 5% in the S&P 500, like to them, that's like the end of the world. 10% is like crazy to them, right? For me, I need 20% plus. I need 20% plus to really get me going as far as S&P 500 drop. Anything less than that, sleepy. Put me to sleep. Because I've been in this market 16 years. I started in the great financial crisis. We saw the S&P 500 fall over 50% in that, right? I've seen several different corrections where the market would, be down 15, 20, 25% in a short amount of time. The end of 2018 was nasty, right? We obviously had the market crash of 2020, the Rona crash, the fastest stock market crash, I believe, in history in terms of how fast the market went down 35%. Additionally, I witnessed the 2022 market and partook in that, and that wasn't too fun to go through. It was such a fun opportunity to be a buyer of stocks, right? And a lot of us got great deals on stocks. Remember, when Palantir was $7, $6 during that time. I mean, there was a lot of smoking deals. I mean, it's still crazy to me that I got Meta shares under 100. But anyways, NVIDIA is probably 5x, 10x, 20x since that 2022 time frame. But there was another vicious market crash there, right? And tech stocks got it the worst. And so, 5, 10, 12%, put me to sleep. Like that's nothing. I've been through some of the biggest market drops we've ever seen. So for me, it takes so much to really this is really I went through the fastest drop in stock market history in terms of that 35% drawdown we saw in the 2020 crash. When I started the 2008, 2009 crash, that was one of the biggest crashes in the history of the stock market, right? The tech stock crash, that was wild. We saw the greatest tech companies in the world in 2022 go down peak to trough 50, 60, 70, 80%. That was tech bubble-ish. But the difference is that was with super legit companies. The tech bubble was a joke. Those companies were a joke. And so when they went down 60, 70, 80%, it was like, okay, it is what it is. We're talking about these were the most powerful, greatest companies in the world that got sent down 40, 50, 60, 70, 80%. That's a big difference, right? Next one up here. We're at a pivot point in the economy.
Capital Management, also former President of Morgan Stanley Wealth Management. It's nice to see you, sir.
Great to see you, Andrew.
I think we're all trying to figure out what's happening in this crazy market. There's, as we get to October's always that scary month. September, you and I, we've all lived through September also back in the day.
That anniversary is coming up again.
That anniversary is coming up as well, back in 2008. So where are we really, in your mind?
One thing I'll say is that people get agitated quickly when markets start to move.
Exactly.
But a few fun facts for you. If you go back to 2011, there were 35 days where the market moved up or down more than 2%. Mm-hmm. And in 2012, there were 21. In 2023, there was 1. And so far, there's 3 this year. So we're at a pivot point in the economy where the Fed is obviously moving in a different direction, where things are clearly softening. You look at the numbers yesterday, the beige book and employment. So whenever you get to a pivot point in the economy, you're going to see more volatility. And it's just normal. It's the market kind of flushing and working its way through in terms of what's going to happen now. So I think a lot of this is just normal market reaction to a changing macro backdrop. And the volatility has been extremely low in the last couple of years.
So what are you telling your clients, though? You have a lot of high net worth clients in the world who are all trying to figure out what they're supposed to do with their money. Some of them have cash on the sidelines and they're sitting around. And some of them are asking, hopefully they're not asking, are we sitting in September?
Yeah, volatility has been fairly low. Obviously, volatility was a huge spike in 22. We know about that, right? But then 23 was fairly lame, other than SVB, when we had that situation. What was that, around March of 2023 or so? That was interesting. And then outside of that, it has been a pretty sleepy VIX for the last couple of years, really.
Of 2008. But we're also at an election year, by the way. Also happened during 2008. Adds to the volatility. How bad is it out there? Is this a moment to be stepping back in? Is it a moment to wait because you think that things are going to be crazy?
Well, one more factor. If you go back to 11, 12, where there was a lot of volatility and a lot of macro uncertainty, the S&P's up almost 500% since then. So what we tell our clients, and we have the best advisors, private advisors in the industry, they have a long-term plan in place with clients, and they say stay steady with the plan. Clients and advisors right now are looking at the election. There's more uncertainty, but they're sticking with...
What do you tell them on the election front, by the way?
It will matter who the next president is. I mean, the debate around tax plans, you're starting to see a little bit more specifics come out here. One thing that's amazing to me when we get into the election is everybody's staying away from the most important issue from an economic standpoint, which is deficit spending. You don't hear either candidate talking about deficit spending. The American people, the American economy, we are spending $3 billion a day in interest expense now. Weekdays, weekends, $3 billion a day in interest expense on the debt.
Yeah. So for us educated folk, that drives us crazy, right? We look at it and we see the candidates not really addressing this stuff the way they should be, and really not having great plans around that. And we're kind of like, come on, but it's brilliant from kind of just an overall, because at the end of the day, let's say the candidates, whether it's T-Man or H-woman, should we call her H-woman? That'd be weird. Harris or Trump, right? If they spend time talking about that, it's going to put people to sleep. Deficits, they don't want to hear about that. The masses don't want to hear about deficits and what you're going to cut the deficits. All they want to hear about is you're going to fix all their problems and you're going to make all their problems go away. And, you don't even have to give the specifics around that. Just tell them it's all going to be okay and I'm your person and the other person's going to fail you. And that's all you got to do, honestly, and you'll grab votes. And so don't get into deficits. But for a minority of people that really enjoy and would love some high-level talk and debate and numbers around that, we're not going to get it. I just tell you that. And it's unfortunate, but it is what it is.
When I was on here, I talked about how interest expense on the debt was going to exceed the defense budget. Well, now it does. And you don't hear anybody talking about the fact that at some point, and it's not so far away now, we have got to, as a nation, this isn't a political statement, it's a statement about the country. We've got to deal with this issue.
It's a statement about math.
Math. It's just math, Becky. You can just avoid the whole political debate, which party. It's just math. You can't continue to spend 6 to 7% deficits as a percentage of GDP indefinitely. No country has successfully done that ever. Sorry.
No. Go ahead.
Well, I was just going to say, you're an expert at the markets. Markets are the ones that sit up and say, no mas. This is not going to happen anymore. It's when is there a pushback on Treasury buying to say we're not going to continue to do this because the politicians aren't going to address it until their hand is forced?
Becky, it's a great question. And I still think that at some point here, you could have a higher rates farther out on the curve simply from a supply and demand standpoint. Because
the Fed can't lower rates and have it stick, the market would say.
The market says no. They start pushing back on the Fed. The amount of debt that is refinanced on a regular basis now, the numbers are staggering. So at some point, the market will rein that in.
By the way, I don't disagree with you. I agree with you entirely. The question then gets to the hard part, which is which services is the U.S. government not going to provide to which Americans, right? And so what happens, by the way, I think is a lot of...
So this is reason number two, these folks don't get super into that, right? Is all of a sudden you start talking about you're going to touch this area or this area. Next thing you know what you start losing? Donor money. Because all of a sudden you mention the wrong industry, and then they're like, wait, you're going to cut back here? Oh, okay. See how much money we send your political campaign. See how much money we send your party, right? That's why these candidates, one, it's not going to win them real votes, right? Because so few people actually care about this sort of subject, which is so important. I wish more people cared about it, but they don't. So you're not going to win votes, and you're going to lose a bunch of donor money? You think they're going to go down that rabbit hole? Oh, yeah, we're going to... No, of course not.
Us talk about how we got to cut, because that's the only way the math is going to work. And they say, well, we can afford to live with whatever the cuts are because we are not going to be the ones that are hit by whatever those services cuts are because we've been lucky enough to be in a place where hopefully we can afford some of these things that maybe other people can't. So the question therefore then gets into sort of the nitty-gritty of it.
Well, let's go back to math, though, where Becky was. Just the math of it. The deficit today is a result, when you look at long-term trends, 50 years, as a percentage of the economy, it's spending that's out of whack.
100%.
Revenues are where they've been for the last 50 years. So there has to be some agreement on what can't we as a country afford, because the blip over this recent time frame that's created such a significant increase in the deficit is on the spending side. So there has to be and this is where, there is a center to the country. What, some people say 85% of people are really in the center. The center needs the political parties, and maybe the markets will force it at some point. And when that happens, though, Becky, because I ask all of my friends who are around this topic the same question. Okay, so what's going to cause it to pop? People have talked about we lose the reserve currency, maybe rates spike beyond the Fed's control. When is that going to happen, and what will it be? But if we get to that point, that's going to be a big problem, because it'll be something that nobody foresaw.
It's not going to be a clean or easy fix.
It's not going to be a clean or easy fix then. It'll be forced.
100%. 85% near the center? I think maybe back in the day that might have been true. I don't know if I believe that nowadays. 85% in the center? I think there's way more way over theirs and way over theirs nowadays, from what I see. So maybe 50% in the center, 60%. But I think there's a huge number of folks that are one way or the other, big time. August jobs report doesn't scream a recession, says Tim Seymour.
Morning's numbers justified. Tim, what do you think?
I think it was. Now, I said last night, I actually thought we were going to get a surprise day. I thought we were going to get better numbers than we got. So I'm at least trying to hedge my comments, because I think we've all felt, at least, bad news is not just bad news, but it's really bad news based upon what we saw on August 2nd and that last July payroll number print that we got in August. So the question is, this number at 142 doesn't scream recession. What it does do is it actually puts the balance of risk to the soft landing scenario, I think, to the downside. And I think that's part of what you got here. I mean, I think you had a whole lot of dynamics in this, and where we're getting now, the underperformance in this market, I think kind of speaks to where I think people should be most concerned about, where you had the most exaggerated kind of moves. And again, I would just say what we've seen from the bond market is really fascinating, because, again, equities, credit don't tell you that they're worried about recession or anything close to it, whereas commodities and absolutely the bond market, and that move in the 2-year and what we've seen, and we've talked about this disinflation of the yield curve. Suddenly that CPI number next week, I know this sounds like a new concept, but get used to it. We don't want that to be too weak. Actually, a little inflation. Deflation is obviously the devil for markets, and that's something that you see after bubbles of all kinds. So, I mean, it would be kind of weird to say, let's pull for some inflation, but I don't want to see an overly soft inflation number.
Yeah, it's interesting, though, because expectations were not that high, if you think about it, heading into the print. And if they had come out with a number that was sub 100,000, which is what last month was revised to, I think it was, the number was, 89,000 or something like that.
That's the complexity of this market, right? If people start saying sell stocks because inflation's too low, that's going to be wild, right? But can I see people going that route over the next 3, 6, 9 months? There's a potential. Whereas people are like, look at a CPI number, and if it's too low, they'll say, oh, this is bad. Because companies can't really increase price. There's no real price leverage out there now. Inflation keeps dropping. It shows that there's no pricing power for many of these companies. There's a drop in price. We're going to start seeing deflation. So I think he's ahead of the curve there. And I actually wouldn't be surprised if a few months from now there's a lot of people start talking like that, and they start saying, we need a CPI to be up. And that's just weird, because for 3 years now it's been completely opposite, right?
Would have been really bad, and I would have said what might have justified this sort of move. But what's really curious to me, last night we're sitting on the desk, we're talking about the CME FedWatch tool that was pricing in only a 40% probability of a 50 basis point cut. Well, that actually went down today, right? And so I just think that's really interesting. So if markets were trying to bully the Fed into a 50 basis like cut. They didn't get it today. So I didn't think the news was that bad. And you tell me, if the CPI isn't as bad as people expect, then you have a situation where it's probably 25, and maybe investors are disappointed on September 18th because of that. But at the end of the day, I think yields, I think crude, I think the dollar, and I think maybe rates have kind of run ahead of what the Fed might do.
I think the September effect is probably equally as important to all of this.
Just seasonality.
Just seasonality. I think
Yes.
I think it's cause and effect, and what's reality, what's perception. So everyone
100%.
perceives this to be the worst month of the year. It becomes the worst month of the year. The Fed's probably going to cut 25 basis points. I don't think there's a reason to cut 50. Everything else is sort of in line. It's the worst month for the stocks and the market and the entirety of Wall Street, right? So if everyone comes back from vacation, look at the desk. We're crowded now. No one's remote on a Friday. Everyone's back. So what do people do when they're back at their seats? They sell stocks. They sit in front of their computer all day long. If they have liquidity, they use the liquidity to lighten up and rebalance. I don't want to make a big deal about it. I think it's more seasonality.
Yeah, what he says there, that's a lot of truth in that, right? And at the end of the day, it's hard to tell what's reality and what's distorted reality when you're in September and going into October, to be honest, because those are usually bad months for the market. So it's really, I think it's the two hardest months to really gauge what's actually going on out there, because you're going to, if the market downtrends, everybody starts to flip. Everybody starts talking about recession. They start feeling bad. At the end of the day, if stocks are going down, people feel bad. All of a sudden, they start to look at the economy. They feel bad. They feel bad about everything. If stocks are going up, they start saying, oh, you know what? All these Wall Streeters are saying, oh, the economy's okay. You know, corporate earnings are good. You know, and no one's worried. If stocks go down, all of a sudden their opinions flip. So, and I thought about a little bit about more of that Tim Seymour talk there at the beginning of the video, right, where he's essentially talking about this worry about you don't want to see inflation too low. I don't think that's an issue for this year. I thought more about it. I do think that could actually be an issue for 2025, and it actually could be a subject like inflation's too low, and that's bad. But I don't think it's this year. We only got a few months left in this year. We'll only get, 3 or 4 more CPI reports. I think those ones you want to continue to see lower and lower, because, I mean, I'm already convinced, and I already told you guys, I think this a couple months ago, inflation's buried. We finally, the dragon's been slayed, right? But there's probably still a few stragglers out there that aren't convinced the dragon's been slayed. And so I think over this next 3 or 4 months, you can convince even those people inflation's done. And the Fed only needs to worry about the employment market, right? And then you could get into 2025, and that could be a scenario where people do start to worry. They do start to say, CPI is too low. I'm worried about this. We want PPI numbers a little higher than expected, CPI a little higher than expected. That honestly, I think he's brilliant for bringing that out, and I think he's ahead of the curve there. Next one up here. If you want to crush the wealthy for certain things, you crush everyone else for the same thing. This is a really intriguing subject. Looking forward to getting into this one.
A different take on the tax proposals from Harris and Donald Trump is Ben Narrison. He is he founded Tenacity Venture Capital after his time at New Enterprise Associates. Good morning to you.
Thanks for having me.
So you're on the other side of it.
Once again, don't forget to go down, pin comment down there, guys, and get that free workshop here today. Stocks to buy now for 2025, how to position your portfolio and all that good stuff.
I mean, I'm not strongly on their side. I think both of our parties are doing a terrible job. But I'm particularly scared with a lot of the Democratic proposals around not just capital gains, but the idea that you would tax unrealized capital gains.
Right.
That would be crushing, is likely going to be struck down, so I don't know if it's even worth the conversation. But this is all just pablum for the proletariat. This is just like throwing stuff out on how we're going to soak the rich to make people that aren't yet rich feel better. And they're going to crush. If they pass these, you know, on the one hand, she says, hey, we're going to take your ability to deduct startup business expenses from $5K to $50K.
Right.
Thank you very much. But then if you ever make any money, we're going to take it all back from you, even if you haven't been paid. Now, imagine that you start a business, you raise some money, now your business is worth more, and you have to pay on that? With what?
Let me ask you a question. Where do you land? We've talked a lot on this broadcast, including with Ro Khanna, you probably saw, of this idea that the best approach may very well not be, and I think I'm in agreement here, clearly, with taxing unrealized gains. I think it creates all sorts of complications. There are lots of people, though, that have had great success that effectively take loans against those unrealized shares and never pay taxes on them, or are able to push out the tax bill for a considerable amount of time.
Yep.
Sure.
You think that's fair?
Buy, borrow, and die. I mean, it's a reality we live in. I know this is a total sort of...
But I guess my question to you is, would you say that piece of it needs to be fixed?
I don't know how you can, because you punish other people. It's like we have free speech. That allows people to say hateful things, and as long as they don't cross the line, they get to do it. But that means we all get to have free speech. If you start to crush people of wealth for certain practices, then you crush everybody else for the same thing. Why? How would you fix that?
Well, here the distinction on that front is that most people, literally 99% of the American public, can't do that. Right? They can't afford to do that. It's impossible. So they're in a different. It's like a whole different universe. It's a different world. So when you say, it would crush everybody. First of all, it wouldn't crush everybody. But the other piece is, it wouldn't even affect everybody.
My issue is always the same. I don't have a strong confidence that we can understand the unintended consequences. So when we pass legislation to continue to, I was fascinated by this new whatever it is, the efficiency council that Trump wants to pull off. Seems like a great idea. I'm not saying I'm a Trump fan. I'm going to vote the same independent way I've always voted.
But if you were to just look at policies...
Which is how, by the way?
Oh, I just write in Bloomberg, because the last two elections I've been so disgusted about choices, I'm disgusted.
If you were to vote, let's say Trump was not a mean tweeter and, didn't know Stormy Daniels. It just pure... Based on policies, is there anyone in the right mind that is pro-business that would come down? We found 88 guys. I mean, half of them you can find them every 4 years.
What do you do?
You can find the same four. Goldman Sachs. Do you know what it's based on?
The liberal bastion that is Goldman Sachs.
It was based on not closing the border. And it was based on not deporting the 13 million aliens. If you think that that's worth it in terms of a couple of points in GDP, that's fine. A lot of people think it costs money not to allow illegal. Okay, so I would rather, if it's a half point less GDP, fine. Shut the southern border, deport all these people that came in illegal. The other thing was
that's like a policy choice.
No, it's not at all what it is. Goldman and who knows with Goldman.
No, but
fine.
Immigration.
But if you're going to say GDP,
if you take it as you either take it as an economic issue or you don't. Either then we could be talking about abortion.
You want to leave the southern border open?
I don't want to leave the southern border open, but I want to find a way to get.
This took a turn I was not expecting. Oh my gosh! Okay.
I'd like to find a way to get more of those people into the system in a legal way.
GDP will be hurt if you don't. If you do.
Well, the question is there a way to do it in a different way? And
what's the difference?
Both parties have done the same thing. I mean, everybody gave Trump a hard time for his policies on the border, and then they all continue. But nobody gives them a hard time.
But just in general, they raising capital gains, raising corporate tax rate, doing unrealized gains, price controls. No business leader in their right mind, except 88 outliers that we can find for a story, believes that.
Well, the price controls thing is crazy. I mean, I didn't realize I'd moved to Cuba.
It's all crazy.
But if that's where I am, then I guess I'll smoke more cigars. It's just insane. You can't, businesses are highly logical functioning organizations that have to compete with other businesses. Prices aren't controlled by the fact that the U.S. government tells us what we can charge for corn or hamburger meat. They're controlled by the fact that you're in a competitive market. Whole Foods is worried about Trader Joe's. Whole Foods will match prices with Trader Joe's if you ask them to, because Trader Joe's prices are significantly higher. And that's a pretty elite grocery store, right? You got
some of the smartest people in the world that went to great risk, personal risk, like Bill Ackman and Elon Musk and Joe Lonsdale. Some of the smartest guys in the world are willing to go out and know that they're going to get all this backlash for supporting a rapist insurrectionist, because it's so clear that the policies aren't even close. And if you, as a person that understands business and understands the economy, I think it's shameful. What do
you say to the people who say, look, rule of law should be the game? No.
Like lawfare, like calling Facebook and saying don't put the laptop in any of your articles.
Like the rule of law, like what happened on January 6th.
Giving a speech and then they go.
Yes, you want to defend it? Go for it. Go to defend January 6th and call me.
That's all you got.
Would you like to? I mean, would you?
You got that in Russian collusion.
But we have a country that's allowed to elect its president on a popular vote. I mean, I get that we have a system that's slightly off from that. And as I said, not supporting either candidate, but we will get the candidate the people want. And that is going to be the law.
Litigated, and that people
they
they don't have to go hide after they vote for Trump. They don't have to go in shame and hide for voting for an
It
insurrectionist.
is amazing. In California, like when Trump was elected the first time, I know one guy that admitted he voted for Trump. It doesn't matter how you vote in California, let's face it. So my write-in vote is just my tiny little protest because it is irrelevant. I can vote however I want. It will not impact a thing.
But if you had to vote then?
I will still write in Bloomberg. I wish he was more effective as a speaker to common people and he could have been elected. I think Romney could have done a great job. Romney's probably the only honest politician I've ever seen. These people, by and large, are lying.
This is our.
That's what I would say. Like what I've seen with people laying out their plans, with the two candidates laying out their plans this time, it is offering more and more money to try and buy your vote.
It's just pandering. It's ridiculous. Everything Biden did, pandering, which got ruled illegal.
Right.
Oh, let me throw a couple $1 trillion to student loans. Why would I want to do that? Oh, wait, there's a lot of votes there.
Right.
But look, even Reagan sort of gave citizenship to a lot of Mexican Americans and got a lot of that support. So it's happened across both parties. It will always happen. It's a pathetic pandering. It is sad, but it is, look, our system sucks, but it's still the best in the world. So we live here.
Yeah, if you follow me on X, you probably saw what I posted earlier this week in regards to that whole subject. And I can't disagree. I cannot disagree. All right, guys, appreciate you joining me as always. Thanks so much for being here. Once again, pin comment down there, stocks to buy now for 2025, how to position portfolios for 2025. Get ready for that now. And send that over via email or text, however you want it. Much love and have a great day.